Well, as tariff risk gets repriced and some of this positioning from a very well-owned sell US trade is looked to be managed. Obviously, the market's very short of US dollars, long of gold, short of certain equities as well. And that position is getting looked at very, very closely at the moment. We ask whether that's got further to go. Obviously, the US data that comes in over the next couple of weeks are really going to dictate this idea of resilience versus US recession probability. And that's going to keep things like implied volatility relatively elevated with the VIX at 28%. But as markets become very lively and we continue to see the news evolve, we ask what's the next trade and how we trade it. This is the trade-off. Well, hi, I'm Chris Weston, Head of Research here at Pepperstone, and I'm going to be joined in 2 seconds by Blake Morrow from Forex Analytics. And as always, we will be discussing the charts that matter, the flows, the movers and shakers, the news, and how it's all going down, and where we see the balance of probabilities going forward across different asset classes. Mr. Blake Morrow, I've just given you a synopsis. Come in, my good sir. I want to start by what I think is one of the craziest things. I mean, it's great if you're on the long side of it. But, obviously we've got so much going on in the world of macro, headline risk, politics, various factors, and that's throwing markets around. They're trying to price risk and, understand certainty earnings are coming about to ramp up as well. But one thing we did take out last night was the Trump coin. Donald Trump coming out and saying that the top 220 holders of Trump coin may have dinner with him. I'm not sure what they're going to have, probably McDonald's or something like that. But, whether that's going to be in the Rose Garden or somewhere else, we don't know. But, the up 57%. I think that tells you everything that's wrong with the world right now. Did you?
No. But did he say the top 200 holders or hodlers of Trump coin?
Yeah, I'm not sure. But obviously the market like crazy, that. And I think that's, I'm sure someone knew about it beforehand and made some very, very tidy money on the back of that. We'll see if that can continue to kick. But I actually quite like crypto at the moment. I think it's a nice segue because, I'm seeing signs now that, Bitcoin looks pretty good. I think we'd probably see 100,000. The flows have been very strong recently. So, probably a good time to crack on into the world of macro. And let's go into Topical Thunder. All right, let's go to managing risk, or should I say managing positions, because obviously what we've seen, Blake, recently is this idea about, Powell's keeping his job. There was obviously people looking to hedge, and I think there was some brand damage done to the idea that perhaps they could explore a way of removing Trump or even undermining him, and that would have caused significant unforeseen situations and consequences in US capital markets. It looks like he's going to keep his job now. I think Trump's obviously been given a tap on the shoulder and said, don't do it, it's silly. And then, of course, we've had the idea about tariffs, and I think the situation with tariffs, which we can talk in a second in a bit more depth. But I think we've seen the worst of tariffs now, and I think trade deals will come, but they may take time. But the news flow from here is probably likely to be more skewed towards positive than negative news. Obviously, the sell US trade was well subscribed. People were buying gold. People were selling US dollars. People were causing outflows of US assets and pushing them into other jurisdictions, which again, perpetuated that selling of the US dollar and separated it from the rate story and relative yield story. With the market seeing signs of Powell keeping his job and tariffs looking somewhat better, is that trade over now? How are we managing those US dollar shorts? How are we managing gold shorts, longs, and equities at the moment? How are you seeing that situation more play out?
Can we skip to the fourth section right now? I'm just kidding.
Sorry, actually,
I just want to fast forward. Right. No, the thing about I think everybody's in a standstill. Right. You're right. We're all waiting for news flows. I think I think you're very succinct in saying that the worst of the tariff news that we're going to get is there now. It's all about timing, right? It's all about timing, because more about the length of time that it takes to put together trade deals, whether it's the EU, China, whatever, whoever you're talking about, that's where the risk is going to lie. And can these deals get done before? I think there's a risk of recession that's actually starting to percolate a little bit. And I think the risks are probably higher now than they've been in the last couple of years.
Yep.
So as a result of that, the longer this takes to put together some sort of trade deal, the more risk we are at the markets succumbing to natural forces downside risk. So I think the ranges are very well established, and we're going to talk about some of those and some of the break points that I see in the markets. So stick around for the next. I want to
jump in because you bring up the recession risk. That to me is now we're looking at the fallout from this, and I still think that people have just don't have the level of visibility. Companies are so many more companies now are refraining from guidance from the 20% we've had so far. But for me now, it's about the data, right? So we've priced in the worst of the tariffs. We compare that back, and that's going to be a moving piece. But bilateral trade deals with China, as we said from Bessent, are going to take 2 or 3 years. Yeah, I think we've got to go and look at the data. We're on recession risk now. Whether it's going to get a resilient economy or increased recession risk. So, yeah, the S&P Global manufacturing numbers and services numbers were a little bit mixed, probably a little bit better than feared. But going to the 29th of April, we've got the JOLTS report. That comes on the same day as consumer confidence and core PCE. So and Q1 GDP. So that date's a big one there. So really we're going to get increased that probability, which is probably a price about 50% at the moment on Polymarket for a recession over the next 12 months. The day after that, we've got ISM manufacturing numbers. The 2nd of May, non-farm payrolls numbers. Now, I think the market goes into this with probably a consensus number about 100,000. But I think there will be some economists out there calling for a negative print. And if that was to materialise, the dollar's going to get whacked. And the Fed will need to come to the party in June. So that to me is a window where I think we're going to see, people really looking at that theme. So that could really push gold back up again, depending on. So I think now we're all about the fallout, from this issue. And that is not something that we're going to get overnight. So we're very data dependent. And that's where we are now.
Yeah, and gosh, you're right, Chris. And there's so much more. We could actually stretch this segment out for many more minutes, but we're not going to. We got to. No. I know we have to move along, but there are a lot of data points that are really going to matter in the weeks ahead. But let's talk about something. Let's go to the next topic and talk about the China trade war, because you just said something was really what I want to pay attention to. Bessent he was being interviewed today at. I was just watching the interview just moments ago.
IIF or whatever.
Yeah. IIF. Not IMF. But anyway, he was being interviewed, and he said, "Hey, China-U.S. trade deal could be 2 to 3 years." The market did not like that. The response from the market was clearly negative at that moment in time when he said that. Now, Trump came out and said, "We're talking." China and the U.S. is talking, and we've also got communications that Xi and Trump, there's no scheduled talk. They have not talked on the phone.
He's just told us what we wanted to hear, right? He's got if he said, he's got to say we're talking. Whether he means it's another thing, right?
Well, that's the point, and the point is that how far in these discussions have they even started, and when are they going to start? And the longer this drags out, that's why I want to talk about time a little bit here, because in our community, in the Forex analytics community, we were talking with a bunch of traders today, talking about. China just doesn't have the time. Either does the U.S. at this point. The tariffs, whatever level they're going to end up being at least in the very near term, is going to have a negative effect on the market or on supply chains, orders, future purchases, whatever sentiment. It's going to weigh on sentiment. And China is already coming into this. I don't want to say disabled, but they're coming in a little hurt. Their economy is not screaming on all 6 cylinders or all 8 cylinders or however many they're pumping right now. It's not a full engine. And the U.S. too, we're on the verge as well. So how much time do you think it's going to take before the markets say, this is dragged on long enough, and it becomes more of a timing issue than anything? What are your thoughts there, Chris?
Well, I've seen analysis from certain economists who say that if tariffs were to stay at this level on China without being unchanged, in the next 12 months, it could have a 3 to 5 percentage point hit to their GDP number. So how they're modelling that is spurious. But yeah, I mean, it's obviously not going to do anything that's positive. What China does have the capabilities, though, is look inwards, and they can spur significant demand. If they're not going to get it externally, which of course is going to hit, they'll need to go out and ramp up the domestic demand, which I think would be a very positive situation and lead to some pretty good trading opportunities in that situation. But yeah, look, I mean, yeah, if they're cut off from the US for a long period of time, it's about 14% of US imports. That's going to really hurt them. There's no doubt about that situation. So time is not their friend. You're right. What we heard is the idea that something does need to come to the table. Now, Trump will feel that he's got the leverage against China in that situation. If he's trying to be Mr. Nice Guy, we've got a seat there waiting for Mr. Xi. If he doesn't want to come to the table, then that's up to them. But if he does, we could see lower, 50, 60% tariffs, perhaps tiered, depending on the import and whether it's of strategic importance. But to thrash out a full bilateral trade deal is going to take 2 to 3 years. It's not something that's going to take overnight, and that's going to be similar with Europe as well. But yeah, look, they could get lower tariffs, and I suspect that at some stage the market is expecting that to happen. But it requires them to have open dialogue between Xi and Trump and Bess and the team there as well. And at the moment, we're not seeing any clear signs of that. In fact, they're actually saying perhaps we could see non-tariff related issues ping through. And the other factor is why we need to move on, and we say that every time. I really am very sceptical of this idea that Trump and the trade team are going to be able to use Asia as a mechanism to go against China. There's just no way Thailand, Vietnam, all those countries are going to come out and say, Trump's going to say, well, you can get lower tariffs if you work against China and tariff them and stop logistical routes through you, because they just need China, and that would cripple their economy. So I just can't see a world where the rest of Asia come out and say, we'll work with you, Mr. Trump, give us lower tariffs, but and in return, we'll go against China. I just can't see that happening.
Imagine? That's like having a bad neighbor in a neighborhood, like you're pointing to your next door neighbor or a house 3 doors down, and you're like, those people are horrible. Let's all gang up on that person. I mean,
yeah,
maybe that's a bad analogy.
I think it's a cheeky tactic, to be honest, but and I don't think it's going to see the light of day personally. Anyway, let's move into US dollar flows, because what we've seen is euro dollar push up into 115 or so. The Dixie, the dollar index, got down to 98. It's pulled back up. It looks like it's in. We're talking about ranges. Looks like it's maybe stuck in 100 sort of 98 range. Aussie dollar pushed up into the top end of its range of 64 cents, and it looks like it wants to creep back down, although seeing some signs of tractions in the Aussie dollar against some of the crosses. I know you're going to touch on that one a bit later on. I like Aussie CAD a little bit higher from a relative rates perspective. But yeah, on the dollar side, we've seen big moves up in dollar Swiss. Obviously, everyone was long short dollar Swiss as that primary sort of hedge against craziness in chaotic markets and what was going on with Powell and various factors. So that's had a big move down. Obviously, the things that can move the fastest down can also move the higher furthest up as well. And dollar yen's had a nice push from 140, just below 140 up until where we are, 143 or so.
143 and change, yeah.
Yeah. So the question now is have that repatriation flows done? Is brand US so damaged that we're going to see further selling? Or is it now the data that's really going to drive? And if the data comes in better than feared, more resilient, we price out recession risk, which is about 50-50 at the moment. Or do we see a real deterioration, as most people expect, increases recession risk, the Fed have to come to the party, meet market pricing, and the dollar goes down again? How are we seeing this?
Well, first of all, I want to tip my hat to The Economist for top ticking the dollar. So they did a really great job, as they normally do.
They did.
It's horrible. I mean, it's great. I mean, if you know what to look for. Anyway, I think you're right. We have to start looking at data. We are going to talk about the ranges. I think you just mapped out a lot of the ranges that I'm looking at. I think there's a little bit broader ranges too to be looking at in different markets, which we'll talk about. But as far as the dollar flows, I had a really great conversation with a ex IMF hedge fund manager today named Mark Dow. You might be familiar with who
Mark Dow,
he is.
Yeah.
And I've known him and I've interviewed him probably a dozen times over the last dozen years.
Everyone at home, check that out after you've watched this.
Yeah, of course. Yeah, it'll be out in European hours tomorrow. It's great because he really kind of debunks the whole sell U.S. trade, and he like he points out that a lot of its flows and a lot of its positioning and it's going to be squared away. And so now this is where our focus, as far as the dollar goes, I think we're going to need a driver. We're going to need a driver to get the dollar to move from current levels, which brings us to really the last topic, which is about the range. And I think this is really an important topic for us to discuss today, because you just rattled out a bunch of numbers with all these different currencies, which I think is important for people to really actually take a notepad and understand where the top end and the lower end of the range is. It's something that I'll tip my hat to our UK colleagues at the UK Trade Off. Ryan, he was talking about the 115 level and the euro being a huge level, and I agree, it's a huge level. But I also agree that the 112.50 level was a big level in the euro as far as a breakout, as a multi-year breakout level. So we got like a 250 pip range that now we kind of know where the sandbox. I always say where the sandbox is. Now you play in the sandbox, try to play around the ranges or the outsides of the sandbox, but you know where that level's at. On the week ahead video, I do a week ahead video every week, Chris, and on last weekend I talked about the 5,100 level being support in the S&P. We bounced off there aggressively. 5,500 level being resistance. We hit 5,473 today. So that range is now very important. 5,100 to 5,500. Above, it's probably some major trade deals been done. Below, shit's not getting done, and it's probably breaking down. You look at gold. Gold looks like we actually did put in a really important high. I'm not really too sure where the lows are going to be. I'm not sure where the lower end of the range is. I suspect it's probably around 3,100, maybe 3,000 or so. But that's kind of what I'm looking at right now with silver and the dollar yen. I think the upper end of the range is about 144.50, which I just put actually in my chart of the day just about an hour ago. And then the lower end is the neckline at 140. Obviously that 140 level has more to do with what happens with U.S. Japanese trade talks over the course of the next couple of weeks. But I think these ranges are going to be pretty important. I'm sorry, I didn't mean to talk as long as I did.
You've said everything that I was wanting to say, to be honest. I mean, I think everyone, a lot of the equity guys, everyone's talking about 5,100, 5,500 in S&P futures. 55.28 was the high that we got on the 10th of April or 12th of April. And that, we had a chance to go and break that last night. They obviously said the Besson's sort of 2 to 3 year trade deal saw the market drop 2% on the back of that. So I think we want to try and break out. Maybe earnings are going to be the thing, because I think the bar to beat in earnings is going to be low. We've got Alphabet coming, or Google coming out after market in my session ahead, your tomorrow, and the market's expecting a 5.7% move up or down on the day. And obviously what they say about capex spend could really ramify, for certainly for calendar year 2026, could really impact the AI trade, because we wanted to see what the hyperscale businesses are doing, and I think that's going to be a big one. But you've got 5,500. 5,100 in S&P futures. You got 460, 420 in US 10-year treasuries, and of course you've got the so-called Bessent put that's in place. I don't want to see the 10-year much above 450. We talked about the dollar index, perhaps 198. There are some ranges which, if they break out, can define some further trends to play through. So an interesting one, but I think like you're right, you've got that sandbox, know your risk. Let's move on to charts. We talked a little bit in words, but let's bring up the pictures, bring up the charts that matter. I want to talk about gold, because gold, everyone's been talking about it lately. It was on just a blistering run. We're hedging against Powell's early dismissal, potentially exploring, potentially being undermined. That's obviously been pared back a little bit. The chaos around tariffs, that's been pared back a little bit. Market obviously was saturated in longs. We'd seen, the GLD put call skew was in the calls were significantly there. We'd been seeing, the price relative to the 50-day moving average had moved out to about 3 standard deviations, and people were saying things just positioning wise, technically wise, were just overstretched. We needed something to do that, and now obviously with Powell certainty there, and tariffs looking a little bit better, or at least priced in the worst case scenario, we have seen that moving out. What we saw gold yesterday was gold really gapping down once Trump came out with that announcement that he's seeing some signs of better dialogue with China over time, and that Powell got his job. Price gap down about $70 or so. it filled the gap, rallied back up, filled the gap, and then came back down. And that's where we are at the moment. We're holding the 38.2% retracement, that recent run up. So it's a bit of a make or break time. Some of that, a little bit of positioning's come out of the market. Now, as I say, I think with gold, those two factors for hedging have come out. But where we are now is for me, this is about the US economy now. And I think if the dollar's going to rally because the data comes in consistently better than expected, then I think gold's probably going to push down, to the orange horizontal line. I think about 32.45 or so. But yeah, obviously, if recession risk increases because we see all that data I talked about, jolts, consumer confidence weaker, PCE, Q1 GDP, ISM manufacturing, non-farm payrolls number coming out weaker, and it's no guarantee that they're all going to be weaker, of course. Then, I think the US dollar takes another leg lower, and I think gold will probably go back up and move those highs. And what will be especially really interesting then is we'll see June being a default position. Everyone was expecting a June cut from the Fed. The Fed will open up the door, and unfortunately, you look at terminal Fed funds pricing, which is about 3.25 at the moment. If that pushes below 3% in the future, which would indicate that the Fed are expected to take the low point on their Fed funds rate below where they see as the neutral rate, I think gold then goes up. So again, we've seen some of the reasons to own gold for speculators coming out the market. But for me, the big thing is what happens from the fallout of the data, and of course this idea about reserve diversification from reserve managers from China, Poland, Turkey. They haven't been selling in this move up. They've been accumulating all the way up, and they're not price sensitive. They wouldn't have been selling in this move, so they're still in there, and they'll still be doing there as well. So a bit of a make or break time. I think the next move comes from the data as we've been talking about.
All right. Well, if we came all the way back down to about 3,000, I mean that would be like a 15% move lower from the highs.
It's an interesting one because you've got the traders who are price sensitive, and they'd probably they would have probably been cutting out their longs because price will move down is essential for more, and they're waiting for the market to reveal itself, bit of momentum to come back in to get long again. Price falls, we look to get short. But if you're a long-term holder without leverage, you're probably welcoming this move because things don't go up in perpetuity. You need that positioning flush out to get you into a new leg higher. So this is the flush out that may be evolving, and so you're not too concerned about this. In fact, you're probably in some capacities welcoming the flush out because the underlying reasons to own gold are still there.
Yes, I agree. All right, my first setup actually is going to be the doctor, and it's going to be the Dr. Copper, and I think the doctor has a little bit of a fever here. Copper, also known as Dr. Copper, gives you somewhat, quote unquote, the health of the global economy, if you will. Well, I was pretty vocal on Liberation Day, the days coming up to the days ahead of Liberation Day, saying, all this accumulation, it's coming to a head. You probably want to be on the short side of copper right after Liberation Day. And it fell precipitously. Now the bounce has gotten to the 618 retracement up to 480. And I think these are levels now that we've almost filled that gap. The gap comes in around 498 or so, roughly $5. I think now that we've recovered what we've recovered, I think these are fresh levels to be on the short side of gold. I love when you get a very what I call like an impulsive move lower, like we saw in this case. We see a nice massive retracement. I think this is a great setup for a resumption back to the downside, back towards the 200 DMA around 430, and really your risk is just above $5. So I think this is a great setup for a short, especially with all the questions that we all have about U.S., China, and probably China as a whole, and the global economy as a whole. So
I think there's so many people who are front running the idea of bringing copper back to COMEX in the US because there was going to be a 25% tariff, and they were playing the US the CME London spread effectively, the premium, and looking at the arb between the two. Well, not playing the arb, should we say? They were just pushing out the arb. But I think now it comes down to economics again. Do we reverberate? Do we go back to looking at copper? You talk about it being the doctor. Is obviously copper's used in so much in very industrial factors, in housing and all these factors. But now is it time to revert back to those economics again? We go back to our old friend the data. If the data comes in weaker, perhaps copper does head back down to those lows we'll see, or somewhere close to that point. So that's an interesting one. Let's go to crude as well, because that's, obviously hasn't been as well traded by by clients is what we've been seeing in gold. We've seen crazy volumes coming through there, and obviously the fact that gold's 1 week and 1 month implied volatility is at 25% or so, tells you that people are, that movement is really attractive. But crude's had a really nice move. We got up to pretty close to $65, which if you take that line out, if we take the chart out, you can see that's actually hit those lows a number of times. So it is a really well-defined range lows for a couple of years. Now we've come back up into those lines. We've created a bearish outside day reversal yesterday, and that was driven by the news that OPEC, potentially by Reuters, are saying that OPEC might look to increase production capacity from June. Again, that's the second time. And Trump will like that to an extent. He was looking for lower crude prices. He was wanting US producers to pump out more. But the problem with US producers is that they, below $60 and certainly into $55, it becomes unprofitable to do that. So you can't have a balancing act in the US of producing more, but it's less. They're not profitable, so you'd have to re-incentivize that. So the easiest thing Trump can do is really lean on the OPEC nations to produce more. The US loses market share, but he gets his wish for a lower oil price and potentially lower headline inflation on the back of that. And that's what we're seeing now. But what we're doing from traders, I think your risk. $65 is, or $65.50, whichever you're looking at, our cash price or the futures market, is your defined. So obviously it's looking at stops. That's where we'd look to square and reverse potentially. And we're pushing up this trend support, which is defined by those higher lows we've been seeing. So can we go back and visit those lows? It's been a nice move up in crude, but I think the fundamentals are changing now. If the economics deteriorate, perception of demand falls, OPEC are producing more, the price is the price. I think this is a great setup. If it breaks through those trend lows, I think we probably head back down towards sort of below $60 again.
All right. Yeah, and I love that. I mean, the way it pivoted off that 65.20 level or $65 is perfect. Perfect. To the textbook kind of move. Yeah. All right, Chris. My last setup is going to be the euro dollar. We've discussed it, and this is a massive breakout, by the way. That black line that it looks like a triangle resistance. That black line is actually the trend line that goes all the way back to 160.
Put it on a monthly chart, Blake, because that is defining, isn't it?
It really is. And so the reason why I wanted to point this out is I do believe there's a range in play, but the bottom end of that range is that purple line, which is you could go back to July of 2023. Those are the previous highs, 112.70. Even last week, we dipped to 112.49, just enough to shake the trees, try to get some people out. And then we just went ripping right to 115. 115 is a major resistance level. It's been a big pivot. Ryan Littlestone from the UK Trade-Off, he talked a lot about it. He talks about it on a daily basis on our shows. I can't get him to shut up about it. So we actually know that that's the upper end of the range. Lower end of the range is just below 113. And I think you just got to play it, but you got to play it with more of a bullish bias. As Chris just pointed out, you look at a monthly chart, you look at a weekly chart, I think the euro looks like it wants to see 120. Now, whether we see that has more to do with headlines, trade, what develops, whatever was going to develop in the next couple of weeks, maybe with U.S. economic data, but it looks like it wants to make a push up there. So I'm still trading with a bullish bias, but I'm using the range low of 113, pretty much where we're at right now, to play longs off of there. So
great stuff.
That's the setup for me.
Perfect. If it was to revert back to some of the old school yield spreads, difference between German bonds, US treasuries, relative rate settings, expected rate settings. The fair value I've got for euro dollar is 108.50. Now, we've seen a massive divergence as we talk about repatriation flows. If we were to go back to a world of looking at those relative rate settings, which I'm not saying that, but if we were, the fair value on euro dollar at the moment is about 108.50. So we'll see what happens if that actually plays any catch up there at all. Anyway, let's go to play of the day. I'm going to go for Bitcoin. Now, what do I like about Bitcoin? If we could bring the chart up. Look, we saw a really nice base being formed. We saw 80,000, 76,000. It was sort of just really toying around there. But the sellers were trying to push it down. It was getting mopped up really nicely by the buyers. And we saw earlier in this week, the ETF flows have really started to pick up again. Institutional buyers have come back into the ETF, into the IBIT. into the iShares ETF. I think we saw about $1 billion earlier in the week, and that was going in a fairly unhealthy risk-off market. So that really caught my attention. And what we've seen then is we saw that 8-day consolidation in the last, and then we saw a powerful move through, range expansion on the second day, market finishing pretty close to the high, and follow through there. Now, would I chase now? Yes, I think probably that's the case. But probably for me, I'd be waiting for a little bit of a sell-off through here. And as long as price doesn't close back below that 5-day exponential moving average, I think that this can really kick. It's not going to go all the way up to 100,000, but I think we should be talking about 100,000 again. I like this one long. I'll be buying a little bit of a pullback, a little bit of a retracement. Get me in, bang, up she goes. I'm closing out the trade on a daily close below the 5-day exponential moving average. I've said 100,000 is my target because I think the order book will be pretty stacked in futures and also in derivatives. Around those kind of levels, I think it might be some wood to chop, so there might be profit taking. But obviously in the art of momentum and trend following, you typically try and stay in the trade as long as you can, and that's why you use things like a moving average or an ATR trailing stop as well. But I just love the setup. I love the way that the bulls have revealed itself. There's factors going on with various ETFs and stuff. I like this one higher. I think it goes up to 100,000.
And if you're one of the top 200 hodlers of Bitcoin, you also will get lunch with Chris Weston. All right, so
it won't be on the Rose Garden, though. Maybe it might be out on the steps outside my office or something.
All right, my play of the day is going to be the Aussie Kiwi, which we in the Forex analytics community affectionately know her as Kylie Minogue, or Melbourne's crown jewel, Kylie Minogue. You did know that, right, Chris? She's Melbourne's own.
We don't call that under here. We don't call it down under. Sorry, no. I mean, no. But you can have that. I think it's that because it's like that's the only Australian you've ever heard of.
And I love her. I think she's beautiful. Anyway. I digress. I've been playing Kylie on the long side. By the 107 level, and I do like the setup. It's a multi-year channel. I think it's been very oversold. We're only, as Chris pointed out, China, the news between China and US, I think we could tilt towards maybe some positive news in the near term, which is only going to help the Australian dollar, I think, look a little bit better against the Kiwi. The Kiwis had a hell of a run against a lot of different currencies, Australia being one of them. A little oversold, very divergent on the relative strength. I know where the risk is. The risk is below 106.40. We get below 106.40, I'm wrong. And that's the thing about it being a trader, Chris. I just want to know where I'm wrong. I'm going to be wrong, but if I know where I'm wrong, it's going to cost me X or $1 or $10 or $1,000 or whatever it is, then as long as I can make a multiple of that on a profitable trade on upside target being close to 108 or maybe even the 50 DMA, then I've got a good trade setup. And that's the way I'm looking at it here, not only from a technical point of view, but also from a very crazy Trump infused trade war world that we're dealing with. So There we go.
Oh, I like it. The best traders, the best losers, aren't they, mate? You can take the loss very easily, and you know where your risk is. I like this one as well because next week we've got the Q1 CPI numbers in Australia now.
Out of Australia, right?
Obviously, if they're weaker, the RBA will cut rates on the 20th of May, but it's fully priced. In fact, there's about a 10% chance that they go by 50, and there's no way in the world I can see the RBA going 50 basis points. Last communication we've been hearing is they don't even know if they want to put 25 on the table. So you've got that mechanism knowing that a weak CPI number, weak jobs report, weak wages number will lead to a rate cut, but it's fully discounted. In fact, if you go further out the curve into the end of the year, we're pricing in 4 rate cuts. I mean, it probably feels like there's probably 3. So you've got that cushion of the market fully discounting a rate cut cycle into that. And so I like that as well. I like Aussie CAD higher from a relative rates perspective because I think what's been priced into the CAD curve is probably underdone and there's probably more to come. Same, but I think your trade works well. I won't call it the card.
But we do have Canadian election on the 28th next week.
Well, I haven't even looked at that, to be honest, mate. So,
there you go. It's something to think about. Just when we're thinking.
We've got an election in Australia on the 3rd of May, and I don't think that's going to be a volatility event unless we were to see a situation where the Labor Party were to get less than say what 76 seats is what they need to get a full majority in, without having to go to the independents and the Greens. But I think, if they were to get magically below 65 seats, then that would be quite bad for Australian economics, because they would have to get pretty much all the independents on board, but also reach out to the Greens. And the Greens, if they were to form a government, it will be chaotic. Nothing's going to ever get passed in Australia. They'd be requesting things to end it, negative gearing, tax, a tax review, and all these factors, but nothing's going to get passed. And we need fiscal spending in Australia to support the economy. So that would be where I think the election would be a bit of a concern. But I don't see the election in Australia being a major risk for the Aussie.
All the Americans that are watching this show right now, we're going to all hit rewind and take some notes. So thank you, Chris.
Anyway, thank you, Blake. Thank you very much. And all the people out there watching the show, we really appreciate it. Smash the like button, hit the subscribe. Let us know how you're trading the financial markets. And as always, if we can, we'll try and get back to you as quickly as we can. And we always like to hear how you're thinking about for all these ranges and what's going on with the dollar and gold and these factors as well. Anyway, thanks. See you next week.